What, as you've lived through this year with everyone else, have been some of your big observations, takeaways, if you will, so far from 2020?
I think the first one is how impressive particularly the central banks were right out of the gates, coordinating with governments around the world. Best explanation I've had is that we have this economic ditch, and in order to get a seaworthy vehicle from one side to the other, you need to flood it with liquidity, and they were quick to the gates. And I really do think most companies that were solvent before should end up getting to the other side, largely because of those early actions. So I was impressed with that out of the gates. I've been impressed with the resilience of good and great companies around the world. Our book's a little over $100 billion, so we've got a pretty good view of what's some good, some bad, and some excellent investments. So it's just interesting human resilience rise to this occasion, not just in the private sector, but also, as I say, some of the governments have been impressive and some of the central banks.
Well, it has been one of the bright spots of such a dark time, the quick action, whether it's central banks, whether it's many of the people in industries that your fund itself represents that have been helping us deal with this pandemic on a day-to-day basis. Moving quickly, though, is not something that OMERS does. You're making very strategic long-term bets. Have you had to make sizable changes to your investing philosophy because of the year we've been living through?
Well, we're as students of the markets, so we have 50% of our book, so a little over $50 billion in privates, which includes private equity, includes real estate, includes infrastructure. And then we have another $50 billion in the markets, so 20% sort of credits, or 20 billion of that roughly credits, 30 billion in the markets. And so the truth is, yeah, we've had to be nimble in a lot of places. Some are more long-term, stay at the table, stick with the investments, and we truly are a long-term investor. But some capital market plays, we've been in and out pretty quickly, and we kind of see it in three different segments. There are those assets, investments, et cetera, that have been hit hard. Whatever trends were accelerating against it, that's been exacerbated. So you have to, at some point get out of those positions and certainly not invest more into those. The flip side of that is some really great opportunities that we know are longer term. Some of the technology stocks and things are good examples where, 5 stocks are 20% plus of the S&P 500. And then there's that middle portion where they've probably been penalized. Some people are hitting them harder than we might think. And we think there are real opportunities in that middle portion where there are companies that are sort of behind the 8 ball, but we believe they'll come back. And so those are places where we are looking for opportunities. On the private side, the bid-ask spread's still pretty high. But on the capital market side, those are opportunities to take advantage of the times, as it were. So those three opportunity sets we're studying around the globe and just trying to get it right. And for sure, in many cases, we're pretty nimble, pretty quick, and need to be, even though we're a long-term investor.
So if you unpack there, let's go back to the capital markets for a second, just because what we have seen this year is a decision on the part of a lot of investors to be cautious about energy. And as you know, we just saw that big deal between Husky and Cenovus, whereas there's all this momentum. It almost feels like the same kind of momentum you've seen for the technology industry for renewable related plays. And we're going to speak to the incoming CEO of one of those Canadian players later in the program. Now, I know you guys are thinking a lot about your long-term plan, ESG related investments. Can you just give us a sense on how you're thinking about that area?
Yeah, I think today's world, if you're not focused on it, you're not listening. You're not listening to your customers. You're not listening to your people. In our case, you're not listening to your members of your board. So we are very focused with an ESG lens on all that we do. And that, and I think there's lots of good examples. I mean, the truth is there are opportunities that are being presented by a low carbon economy and environment. And so if you're not focused on it, you'll miss those. There are also risks if you're not focused on what could be around, from a technological advancement standpoint, and to name one obvious example. And we've been on this for now years. We have a sustainable investment committee. Every single investment we look at globally, we put through an ESG sieve, and it is very topical to us. And when we listen to our members, it's important to them. I think OMERS, particularly in our infrastructure space and in our real estate space, have been, if not a leader, we've been the leader in the market. When you look at Bruce Power, we're a 50% investor in that. When Ontario made the decision to get out of coal, we've been investing there since 2003. We committed another $7.5 billion to refurbish that outfit with 4 new units. So huge believer in it long term for the province of Ontario. It currently provides about 30% electricity for the province of Ontario. Our real estate company, Oxford, has won literally hundreds of awards for its focus on ESG policies and thoughts. There's an organization called GRESB, which stack ranks the big real estate companies around the world. And consistently, Oxford's been ranked #1 in North America for large developers because it's very thoughtful about that very thing. We've invested in Leeward Energies, which is 9 states in the U.S. with wind farms, including we just finished one this week where we've put 3 new significant investments in that market this year. So these are all good examples of our commitment on the private side, and we're also being very thoughtful on the public side.
And it sounds to me like when it comes to real estate, and obviously you referenced the Oxford portfolio, and that's a business that you ran very extensively, so you know it inside and out, that this idea of what happens in the world of going to work or going to malls or what have you, that you think we are going to go back to a world where we're out and about and we are living our lives, and real estate is an industry that can bounce back essentially.
No question. I mean, there are winners and losers at this window of time for real estate too. Clearly, retail's been hit hard. We happen to own with Aimco, for example, Square One, Scarborough Town Center, Yorkdale Mall. So we're pretty good students of what's going on there. Those are among the best in the continent. Industrial. The flip side is industrial has really sort of picked up that space because you're getting goods to market in real time, and so we've done extraordinarily well with our industrial portfolio. And office is sort of somewhere in between, right? And so clearly you're seeing a diminution in demand at this point for office space. You're also seeing, for those who are being thoughtful about the future, a need for more space because you need more elbow room when you do, in fact, get your teams back to the office. So the net diminution in demand isn't as bad, in our view, as some people think. And, you know, as our in-house doctor keeps saying, listen, the cavalry are coming. And yes, we have to live with this long term in some instances, but the cavalry are coming. And we're optimistic that as we get vaccines and we get the right protocols in our office product, that this will be a period in history where nobody forgets, but that there will be still a significant demand for our office product, particularly great assets with great mechanical and electrical systems, which represents the Oxford portfolio. So there's a good example, as I talked about the 3 different opportunity sets, where for the right market, for the right assets, if people believe that office product isn't the best opportunity set, there may be real opportunities to buy things way less expensively than, say, a year ago. That's a good example for our Oxford team.
Interesting. And let me ask you a bigger picture question, because obviously as we try to figure out the economic road ahead, and the government itself wants to be involved in a lot of new projects as well, maybe ones that create jobs. You hear about this on the election campaign trail in the United States all the time, you know, big infrastructure projects. One of the things that seems to be still uncertain when new projects are being picked, and we know this federal government in our country wants projects that will involve private investors, but finding that right mix of something that really speaks to what the government wants to build and what a private investor wants to invest in. How are we going to resolve that? I mean, obviously you must be having conversations about that from time to time.
No, it's a very good question, and it's a long-dated question. And the usual issue in the past is the governments look at it and say, your cost of funds is greater than my cost of funds, so maybe we ought to do it ourselves. I think given the times today, governments will be forced to do a lot more needs versus wants, and they will be forced to look at their portfolios in a very different way. And I think it bodes well for private investors that there will be more opportunities in the future than there are today, where governments actually look for an assist, either to get things off their balance sheet or to bring in expertise. Australia's been a global example as to what to do in that space. And I think that our Canadian government is wise to it and will be morphing soon. And I think governments around the world will be there. And the trick really is to sit down in an open book manner with governments and say, listen, this is the yield we would need as a long-term investor who deeply cares about, for example, our country. Our members are 500,000 people in Ontario. We would love to invest in more infrastructure in Ontario. We're a Canadian-based pension plan. We would love to invest in Canada more. Today we have $25 billion invested in infrastructure. We'd like to make it 50 in the next, call it 7 to 10 years. So we're armed with capital. We have good relationships with the counterparties, the governments. And I think more in the future, you're going to sit down and they're going to have a project and you're going to say, this is my minimum yield that I need to meet my pension plan promise. And let's be open book about it. And let's let's not play games. We're never going to take advantage of you, but we need this. And the governments are going to turn around and say, let's go. And I'm optimistic that that will be more true of tomorrow than it has been historically, largely because of the needs versus wants environment, and largely because we're all partners in trying to make Canada hugely successful.